Alrighty, welcome to TradingView, everybody. I am going to go through from start to finish everything that we've covered in this course, and I'm going to show you examples of everything that we learned on Smart Money Concepts so that you can see them on the actual charts and what they look like. As you can see here, I have NASDAQ 100 on the daily time frame. The first thing that we're going to start off with is basic market structure. We're going to look at bullish structure and bearish structure. Okay, so what I have here is drawn out the higher highs, higher lows, and lower highs and lower lows so that you can see the overall higher time frame market structure that I'm talking about. You can clearly see that when highs and lows were formed, they clearly broke through the higher highs. So every time a new high was formed, it had a break of structure with a candle closure above that. Breaking through the previous high, candle closure above, coming down, creating a higher low, breaking through the previous structure. Then getting a trend reversal, breaking the previous market structure, failing to make a higher high, and reversing into a downtrend. This is the overall higher time frame structure that I want you to focus on as your overall bias. Try to ignore all of this little micro movement in between. Just look at the high points and the low points. The easiest way to do that and to actually see the structure is to remove the candles entirely from your chart, just for a second. You've already drawn up your swing highs and swing lows, and you can clearly start seeing breaks of structure. So every time a higher high was broken, we had a break of structure, break of structure, break of structure. Then once price started reversing, we broke that previous down structure. Again, this is a break of structure, not a change of character, because it is the overall market structure on the higher time frame. And now I can start showing you clear, strong, and weak market structure. Because we are in an uptrend, these higher lows right here are stronger than these higher highs because this was the movement that broke this. These are all protected. Then this higher high becomes protected and becomes a strong high because it broke this. Now this is a weak market structure. Then these become the strong ones. I know this is a same high, but just for example, imagine that it's perfect market structure. Strong bullish, strong bearish. Now that we have that explained, I can start discussing internal breaks of structure. Let's get our candles back up on the charts, and now we can start looking at internal structure. Now this is that previous same high we were looking at the daily time frame. And now you can start seeing the lower time frame on the 1 hour, the internal breaks of structure. There are deeper internal breaks of structure within that on a lower time frame like the 15-minute, but this is just slowly weaning you into that smaller time frame. Again, removing all of the candles, you can see the internal structure that lives within the overall higher time frame market structure. Now, because TradingView limits me to the amount of candles I can look back on a much smaller time frame like the 5-minute or the 1-minute, we are currently still on the 1 hour, but this small pullback right here that created the high point on a lower time frame like the 5-minute or 15-minute would also be considered internal market structure. So all of these movements in the bullish direction were all internal breaks of structure on a much lower time frame, and then once price started to come back down here, this right here was a change of character. Remember that change of characters are fractal. A wick, not a body close, can indicate a change of character. Again, that was an early indication that trend is most likely to either retrace or change directions. So zooming out, here's that change of character that we saw in the much smaller time frame here on the overall daily downtrend. So now I want to talk about premium and discount. This is the entire momentum move up, the bullish movement up. This is the retracement, bullish movement up, retracement, bullish movement up, retracement. If you remember what we discussed in premium and discount theory, that if you are in a bull market, you only want to buy when price is in a discounted zone. So of that move, below 50%. And in a bear market, you only want to sell in areas of premium. So 50%, just the top half, only when you're selling. And the same goes for that internal market structure. Every time we had a move that broke structure, that's your move, and you only want to get into sell positions when it's in that top half of the move. You will inherently miss some moves, like you did this one here, as the halfway mark is right here, but if you keep that as a consistent rule, you will always get in a good area of premium when you're selling off the market in the overall downtrend. Okay, so now hopefully you have a clear understanding of the overall market structure, where you're going to see overall breaks of structure as well as internal breaks of structure on a shorter time frame downtrend or uptrend. So now we can get rid of all of that and get into the nitty-gritty of it, because what you want to know is your lower time frame entries. How to get the best possible entries knowing all of that information about the overall market structure. Okay, so let's start looking at order flow. If you recall from the previous slides, order flow usually stays in a range, then has the initiation movement, the mitigation, and the continuation. Clear top to bottom movement, price breaks out with the original order flow of the big banks, the smart money, the financial institutions, comes back in, usually around the 50% level, so that the banks can fulfill the rest of their orders, and then the market cascades down. All this is their first chunk of orders coming into the market rebalances, and then they send the rest of their orders, taking the market down to where they originally wanted. Because the banks place such large trades and such large volume, they usually can't do it all in one swing. First break, come back, retest the 50% level with the mitigation, boom, continuation. It literally looks the exact same in a bullish movement. Here's an inverted look of how it looks. All right, as far as supply and demand zones go, like we talked about earlier, there are 3 different supply and demand zones. There is a range supply, a pivot supply, and a fractal supply. As you can see here, this was the entire pullback. This is the entire range of the pullback, and this was the move that catapulted the break of structure. So this would be considered an entire supply zone because it is pushing the price down. A pivot supply zone would be from the last candlestick up to the top of that movement. As you can see here, if you had your entry point at the bottom of this pivot range, you would not have been tapped into your trade. And then the top wick of that point right there would be a fractal supply. Just so you can see that again. Fractal supply, pivot supply, range supply. If you set your trade up like this, you would have been tapped in, and you would have had a 1 to 2 risk to reward targeting this previous low point. If you would have used pivot supply, you would have not been tapped into your trade, but you can clearly see a higher risk to reward ratio. And if you used a fractal supply, a much higher risk to reward ratio of a 1 to 10, but the likelihood of getting tapped in on these is few and far between. But as a general rule of thumb, pivot supplies are the middle of the road and the best entries that you can get. More consistent and better risk to reward. So when marking up your supply and demand zones, what I want you to do is stick to like an intermediate time frame. I want you to still focus on the internal breaks of structure, but really squint your eyes and try to focus on the ultimate high points and the ultimate low points. The move that initiated the break of structure is where your supply zones are going to be and your demand zones on a bullish trend. When you're drawing these out originally, you don't have to get super scientific with it to the exact point. I just want you to get a basic idea of where you want these things to be. Once you do that, then you can narrow it down to whether you want it to be a range supply or a pivot supply or a fractal supply, depending on your trading preference. This will give you a clear indication of what direction the price is moving and where the demand zones are. Once the sellers and supply loses control and demand starts pushing the price up, demand will always push price past these supply zones because, like you learned in the course, price likes to sweep up trendline liquidity. See how it targeted that liquidity? Grabbed it and then came down. Now let's get into flip zones. As you can see, market was bearish. At this point right here, when price failed to make a lower high and broke through the previous down structure to create new structure to the upside, this right here is known as a flip zone. Price rejected that supply, failed to make a lower low, then had that internal break of structure to the upside, creating a new uptrend. These flip zones aren't going to be always so close, but you'll see more examples of this in the workbook we've provided with this course. All right, so now let's get into liquidity and liquidity sweeps. You can clearly see we had bullish market structure to the upside, and then price rejected down. Above these areas right here, this was a high, this was a strong high. Liquidity already lived above here, price went to take it, started coming down, so even more liquidity now lives above this area. As you can see, it was low resistance liquidity, as there was very little market structure on the way down. Price rocketed up to grab that liquidity and just dump down. This is a textbook example of a liquidity sweep. If you see something like this, take it every single time. This is where the smart money is moving. This is an example of a single point liquidity sweep. Price came down, made a low, literally just 1 or 2 ticks above that, and then swept up to the upside. And then this is going to be your double top, triple top, as you can see right here. We had this high point, and this high point, all the same. Price came up, just swept a little bit of that liquidity and took a dive down. The examples on charts are not going to be textbook like you see with the line drawings. You need to be able to interpret what these are. All right, now we can talk about inducement points. Clearly seeing that this was your higher high, your lower high, which then became your demand zone. Price came up and down, created this demand zone, and had small fractal structure right here. So when it had its pullback into this demand zone, these right here were inducement points. With inducement points, liquidity lives below these areas. Price likes to grab up the liquidity of the inducements into the demand zone and shoot up. Boom, boom. Again, there will be examples of every single type of inducement, the pullback inducement, the leg inducement, and the leg plus the pullback inducement in the workbook we've provided in this course. Okay, so now let's look at Euro USD. I never look at this pair anymore. But because of that, it's a prime example. I'm going to do start to finish analysis and how I would trade this using smart money concepts. All right, so I've drawn up my market structure on the daily time frame. This is what it looks like without candle bodies. So I know that we were in a downtrend and now price is reversing up. Or it could be simply retracing on the higher time frame downtrend. This gives me my overall bias. Okay, so I've marked up the previous downtrend breaks of structure, as well as the reversal breaks of structure, and currently we're sitting in between this high and this high. We are still respecting the uptrend, because this low has not been broken and this high has not been broken yet. So price is dancing in this range, and now we need to find out the internal structure as well as to see if there's any fractal change of characters that we should be keeping an eye out for. All right, so keeping that in mind, all of these low points here are still protected and are still considered strong lows, strong market structure pushing the price up. If this gets broken, this becomes a demand zone. As of right now, this is the current demand zone on the higher time frame. So just looking at this area now, these are going to be all of your internal breaks of structure on that lower time frame. We're now looking at the hourly internal structure of the daily overall market structure. But on this hourly time frame, we did get a change of character right here. Now, because we're trying to get the best entries, we want a lower time frame. We can either go 5-minute or 15-minute. I'm going to stick with 5. At this point is when you can really narrow down your markups that you did before to absolutely get these precise locations, because you're looking at current price action. So even on the 5-minute, it gives you a clear indication that the 1 hour time frame was correct, and this is probably the time frame that you want to stick to at this point. So now we can see this move that was the change of character. So now you know that this is a nice strong supply zone. Narrowing it down even further, this would be an entire range, this would be a pivot, and this would be the fractal. So I'm going to stick with the pivot. Keep in mind that your overall higher time frame bias right now is bullish. But because we did have that lower time frame internal break of structure and change of character, this entire swing down was the move that had that change of character, that broke that bullish structure on the 1 hour. So if we think about that whole movement, this is the 50% line. If we wanted to get into a sell position, we would do it here in the premium range. And what we can do is actually target this supply zone since price was ranging and then broke out. This could be the range, initiation, mitigation, and continuation. So hitting this level and then rejecting down. What we can do is take it out to that daily time frame again and look at this entire swing, the one that started the break of the previous uptrend into a downtrend. Mark out the 50% area, which is right here, meaning that this entire top half is an area of premium where you could get into a short position, assuming that this uptrend is just a retracement on the overall downtrend. And if it does reject off of this area and continue down, you know that it's going to target all of the trend line liquidity that it was making on the entire way up. Now, there are a bunch of smart money concepts indicator. I just picked a random one here and threw it up on the chart, and you can see pretty much all of my analysis is correct. We had a break of structure right here. We had a change of character right here. These are all the demand zones on the way up. This is a strong high. This is that middle of the range supply zone that may push the price down. And since this is a weak low and this is a strong high, it's most likely to reject off of this area and come down and collect all of this trendline liquidity on the way down. What I want you to do is do your analysis first and learn all of the things that we learned in this course. And then to ease your life up and to not have to draw these lines and structure and everything, you can start using indicators to do so. All right, a little bit of a bonus video for you guys. Since you're part of the trading floor, you have access to the trading floor indicators. I want to show you how you can use these indicators in tandem with using smart money concepts. All of these areas where you're seeing rejections off of these demand zones or rejections off supply zones. So just for fun, let's throw on Happy Trail. As from your previous analysis, you can see that we were in a clear uptrend. And every time one of these demand zones were created and you got a happy trail indication, you could have taken a long position, stop loss below the swing, and a 1 to 1.5 risk to reward ratio every single time that price made a new demand zone. Again, stop loss below the swing with a 1 to 1.5 risk to reward. Just in this short amount of time, ignoring the sell signals because your bias is bullish, you could have made 1.5%, 1.5%, 1.5 and 1.5, totaling 6% in a matter of 4 days, 1 hour and 45 minutes on the 15-minute time frame. And because this indicator gives you alerts when it prints, you don't have to watch the charts all the time. You can just wait for alerts on your phone. And you've already marked up your charts, and you now know what supply and demand zones look like. You could let these indicators help assist you in your day trading journey. Same thing using DeLorean, except you can get even better entries as the market starts shifting and you start seeing the green momentum. Earlier entries on every single one of these, giving you an even tighter stop loss, making your trades play out faster and simply targeting the previous swing highs. In that same range with the Happy Trail indicator, we got a 3% reward, a 3.4% reward, and a 2.7% reward. All right. I really hope you guys enjoyed that course. I really hope you got some value out of it. And I hope I was able to simplify smart money concepts for you in a way that's easy to understand without overcomplicating all of the minute details that aren't really that necessary. If you guys have any questions, comments, or feedback about this course, please let us know in the Discord community. Or if you just want to chat SMC with fellow SMC traders, you'll find the group chat for SMC in Discord. Thanks so much for watching, and we will see you in the next lesson.
Hey everyone, it's Jenks, and I'm here to present to you the Trading Floor's brand new SMC Toolkit indicator. The indicator is compiled of various tools, and while they aren't meant to be used all at the same time together, you can absolutely combine more than one of the concepts together to assist you in either forming a trading plan or bolstering the probabilities of an existing one. Please note, for the best functionality of this indicator, click the 3 dots next to the name of the indicator, scroll down to Visual Order, and click Bring to Front. The original focus of this indicator was to assist traders in finding and utilizing mechanically drawn levels every trading day. I'll show you in this video how to turn on and off each of the features within the indicator. I'll also give an explanation of how each of the tools work and the function it serves, as well as giving you an example of how you can combine the tools within the indicator to form a mechanical trading strategy. First up, we have the midnight and 8:30 a.m. New York price lines. Turn this tool on, you come into the settings of the indicator and click Display under the New York Midnight Open and Display under the New York 8:30 Open. The concept for using these two price lines as levels every day stemmed from ICT methodology and states that the Interbank Price Delivery Algorithm, or IPDA for short, resets at midnight New York time every day. Price tends to respect this midnight price line in so much that you generally be looking for longs below it and shorts above it. You can also visualize these price lines as magnets that will pull price towards it in an attempt to keep fair pricing intact, and then eventually the magnets let go and price will take off in its true intended direction. In these cases, you can often find the price lines acting as faux support and resistance. You can continue to see in this example that every time price came up, it rejected the midnight line. We look back to the day before, see the midnight line gets established, price breaks it, and then retests it once again before going off in its true intended direction. Using this knowledge, you can quickly scroll back through previous price data to see how this holds true on most days. As with anything, nothing is 100%, so please do your own backtesting to see how this could fit into your trade plan. Next up, we have Williams fractals. To turn on the Williams fractals, we're going to come to the Styles tab and check the Filtered Top Fractals and Filtered Bottom Fractals boxes. First and foremost, it's worth noting that Williams fractals print late. When you see a fractal above or below a candle, that fractal printed 2 candle closures after the candle being denoted by the fractal. So for example, this top fractal would have printed at the close of this candle, and this bottom fractal would have printed at the close of this candle. So how do we use this in our trading? Well, we can use the fractals as a mechanical way to denote market structure or structural liquidity. From there, we can form multi-timeframe price ranges. So let's hop up to a higher time frame to set that up. First, to make things easy, let's look for a recent turnaround or pivot point in price. This is a place where price very clearly shifts from a bearish market to bullish or vice versa. In this case, we have a bearish market shifting to bullish. So let's zoom in on this low candle. We can use this fractal low as a range low and place a horizontal ray on it, denoting the low of the trading range that we're interested in trading in. From there, we trace backwards to the fractal that caused this low candle, and that would be this fractal, so we place another ray there. Now we have our range low and our range high. And since we scrolled price back to the pivot point, we know that price is immediately going to be breaking this structure. Every time you have one of these ranges break, you can consider that a break of structure. We can mark it just like that. There we go. Now, when we move the range high because of a break of structure, we would also be looking to drag the range low to the fractal that caused that break of structure. You can see that this fractal gets formed and goes on to break structure right here. Now we're just going to keep doing that, continuing along the way. We have another break here. We bring it to the most recent fractal. We have another break here. Bring price to the most recent fractal. Another break here. And no new bottom fractal prints along the way to the breaking of this. So we go ahead and just leave this bottom horizontal ray where it is. We have another break. And we can drag price to the most recent bottom fractal that would cause that break. We continue on. There's no new fractal printed here. So we just continue on. We have a break here. And then we would drag the bottom horizontal ray all the way up to the fractal that caused that break. Now we have a bearish break. We would drag the bottom ray down. No top fractal was formed in the meantime, so the top fractal does not move. We have another bearish break. And now we can move the range high to the fractal that caused that break, which would be this one. And similarly, as we keep going forward, we have another break here. The fractal that caused that break is this one. There is a minuscule break here, so we will cover it. And then we can drag that to here. And then our top fractal range would be moved to there. And then you can see we continue the bullish momentum. This would go here, denote a break of structure. This would continue to drag up. Likewise, this would drag up, denote the break of structure. Here's the fractal low that caused the break of structure. And now we can just start dragging this to the most recent price. Okay, and then this would eventually get dragged, earlier on it would start here. Then as price keeps developing, this would eventually move here. And now, most recently, this is our fractal price range on the 4-hour. I first learned about using Williams fractals to form multi-time frame price ranges from Scott Taylor and Evolution Markets, and they have a great mechanical way of using the fractals and ranges to form a bias as well. For general use trading, it's often best to just default to the tried and true method of buying low and selling high. So let's take our 4-hour range and plot a Gann box to denote the equilibrium, which is just the 50% line of any given range. Now that we've identified our 4-hour range high and range low and drawn our equilibrium to denote the premium and discount zones of the 4-hour range, we can hop down to a lower time frame to look for reasons to go long from discount or short from premium. The last tool that aids with drawing mechanical levels and biases is the DR-IDR tool originally developed by the master. To access this tool, we come into the toolkit and come down to the DR-IDR section and click any of these 3 boxes. For these 3 boxes, regular denotes the time during New York Stock Exchange trading hours, after denotes the time during the Tokyo and Asian trading session, and the overnight denotes the European or London trading session. From here, you can choose stylistically to shade the box using the IDR or DR. You can change the box line width. You can change the colors and whether or not you want the lines to be solid or dashed. You can change the middle line color, solid or dashed as well as the opening line. You can also change the background color of the box. You can effectively use these style tabs to turn off any features you don't want. Now that we have it loaded up on our chart, let's figure out exactly what DR-IDR is and how it can help us in our trading. DR and IDR highlight these 3 critical times of the day and draws the defining and implied defining range using the 5-minute candle, bodies, and wicks. Let me show you exactly what I mean by that. The highest wick created by a 5-minute candle during the DR time frame is considered the range high or the high of the defining range. The low wick of that same time frame is considered the DR low or the defining range low. The body closure high of that same time period is the IDR or implied defining range high, and the lowest body close is considered the IDR low. From there, the midline is calculated using the IDR. You can see that the equilibrium of the IDR serves as our midline. The theory behind DR-IDR is that once this range is formed and broken in one direction, price will not trade past the other extreme of that range. Let's take a look at this example right here. Price comes up, breaks this range bullishly, retraces, and then makes another bullish move out. Now, this isn't 100% accurate, as nothing in trading is, but this concept alone, this piece of the overall DR-IDR methodology, boasts a nearly 80% historical accuracy. We can use this kind of historical accuracy to form a bias and find trade ideas during our trading day. I strongly encourage you to check out Alex's streams for more info on DR and IDR, as he is a very well-experienced trader using this methodology. The last tool we included in this indicator is fractal Wyckoff accumulation and distribution. This tool is more of a potential entry trigger than it is a method for finding mechanical levels, but it pairs very nicely with any of the other tools that you find in this kit. The strategy that this indicator comes from is called the Triple M strategy, and it was developed by MentFX. The idea behind it is that if each individual candle is a whole price range on a lower time frame, then we can use scenarios highlighted by these wicks to denote the fractal spring or upthrust after distribution phase of a Wyckoff schematic. These springs and UTADs can serve as an entry trigger when combined with other confluences, such as previously established biases, points of interest found within areas of high probability, as well as kill zones. Lastly, here's an example of how you could combine these indicators to form a trade idea. First, let's establish a higher time frame price range using the Williams fractals. Just as we did before, let's come to our lowest low where there's a fractal printed, and mark with our horizontal ray the bottom of that range. Now let's trace back to the fractal that caused that break, and we get this one. Now as we continue price forward, we see that this fractal gets broken in the form of a break of structure right here. And then the fractal that caused this break of structure is this one right here. We move the range low. Now that we have our higher time frame range drawn, let's go ahead and use the GAN box to put in our equilibrium to make sure that when we go down onto lower time frames, we're operating within our fair pricing model and buying low and selling high. One last thing, let's turn off the Williams fractals just to declutter a bit. Now that we have our higher time frame range marked up as well as the equilibrium, let's jump to a lower time frame and see if we can get a bias from our DR-IDR tool to match up with the fair pricing model left behind by the higher time frame range. When we do, we can start to look for entries using the Wyckoff wicks. This is what we're looking for. Now that price is broken out of the DR range, it is established that the bias is bullish for the rest of this trading session. Since this bullish bias appears while we're in the discount of the greater 4-hour range, I'm interested in participating in the market. Let's look for a Wyckoff wick during a retracement to give us a clean entry signal. Here we go. This is exactly what we're looking for. Price confirmed its bias by exiting the DR range. It retraced to the DR range. It gave us a Wyckoff accumulation in the form of a spring, and we're looking to go long here. At close of candle, we would cover the swing low, in this case being this candle itself, and let's just target conservative 2R. As you can see, this trade goes on to be a winner. I want to reiterate to you guys that this, what I've presented to you today, is not a formalized, back-tested trade plan. This is an example of how you could combine these tools together to form a trade plan. I hope you guys enjoyed trading with this indicator, and if you have any questions, please feel free to ask in chat. Have a great day, and I'll see you next time.
Hey guys, I'm Jenks from the trading floor, and I'm excited to share with you some recent updates to our free SMC Toolkit indicator. Let's load it up. In TradingView, pull up the Indicators tab and type in TTF SMC Toolkit and click on the star to add it to your favorites, then click on the name of the indicator to add it to your chart. In this update, we made some quality of life improvements to the DR and IDR functionality of the toolkit, so since we're working with just that, let's go ahead and turn everything else off. The midnight and 8:30 a.m. lines, and the 2 sets of fractals. First thing you may notice as we're scrolling by and turning off the other features is we've added toggles to each of the DR functions. You no longer have to drop the opacity to 0 to turn off one part of DR and IDR, you just have to click on the box. Next up, we renamed regular, after, and overnight, or RDR, ADR, and ODR, to New York, Tokyo, and London respectively. We felt this made it a bit easier and much more accessible to people who are newer to the concept overall. Now, I want to skip this part here for a bit and scroll down to this, the closing price. It's exactly what you think it is. Just as we had the DR opening price line, now we also have the DR closing price line. Now you can easily use the toolkit to find the daily levels provided by each DR session's closing price. Now coming back up to here where we have the days marked out with toggles. This is a function that was highly requested in our community, so we wanted to get it implemented as soon as possible. Clicking on any of the days of the week here will extend the DR lines for that day's New York session. Many traders who start trading DR quickly realize that DR levels from earlier in the week or even the week before very often act as support and resistance. Price respects these levels. This DR extension functionality is here to help you backtest what works best for you with the asset that you trade. So whether you like extending yesterday's DR levels no matter what day of the week yesterday is, or you like picking one day out of the week to drag out till the following week, the toolkit will now draw those lines for you. If there's any other updates to the indicator that you'd like to see, let us know in the comments down below.